George Tanner of the University of Idaho. If you don't know Kevin Learned, you should. Kevin's worn many hats over the years at the Venture College, Boise Angel Alliance, Loon Creek, and Sage Growth Capital. If you've come across Kevin at all, you know that he's passionate about entrepreneurial ventures. So much so that Kevin was recently honored by the Idaho Business Review as an Idaho icon for his lifetime achievements. Welcome, Kevin. Bruno Chahon is a business banker with Zions Bank. He's located in the Meridian Silverstone branch. Bruno recently moved to the Treasure Valley from Alaska, so welcome. Bruno has many years of experience in conventional bank financing and will share today about SBA loan options, particularly good programs for newer companies and those in higher risk industries. As a business owner himself, Bruno can relate to the challenges and opportunities our Growth Track attendees face. Dave Glazer didn't begin his career in community and economic development, but in the sciences, with the goal of finding something to do that he was passionate about. Fortunately for entrepreneurs, he found his passion was helping companies succeed financially. Dave is president and CEO of Mofi.org, a non-bank lender that provides financing alternatives and technical assistance to small businesses across the Northwest. They're busy now with their new Community Advantage Recovery Loan Program, which is designed for COVID-19 times. Listening, flexibility, and helping his clients adapt to uncertain times are what Dave Glazer brings to the panel today. Welcome to all three of you. Let's get started. All right, so we'll start with Kevin Learned. Kevin, tell us who you are, what you do, and what you want us to hear today.
Sure. Thanks, George. It's a pleasure to be here. I'm a partner in a small micro VC called Sage Growth Capital, and we make capital available to growing companies. Our capital is a loan, but it's a much different loan than the other loans you're going to hear about. In that, we don't have an interest rate. Rather, we agree upon the total amount of money that the company is going to pay us back. The payments are variable depending upon the company's sales. And our loans are unsecured. There's no collateral, no guarantees. So how does that work? Here's an example. We might loan you $100,000 under an agreement that you will pay us 5% of your sales until you've paid us back $200,000. So how much we're going to loan you, what percentage of your sales are you going to pay us, and how much you're going to pay us back in total. The advantages of this type of capital to a business is, first of all, the payments are tied to the business's cash flow. If they have a big sales month, they pay us more. But if they have a low sales month, they pay us less. Secondly, because we deal with a contract, not with a typical note, so there's no collateral, no guarantees. Third, this is an alternative to selling stock. It's not an alternative to the capital from the other participants on this session, George. If you qualify for their capital, by all means, you should use it. But if you're thinking of selling stock, this is going to be cheaper than selling stock. And finally, we can move very quickly. It'll take us, if the entrepreneur is ready to talk, has got their material together, we can fund in about 30 days from the time we first receive an application. Who is it appropriate for? Well, first of all, the companies have to be revenue positive. They're going to pay us off based upon a share of their revenue. That needs to be growing revenue and it needs to be recurring revenue. Secondly, the companies need to have high margins. They need to have margins something north of 40% because we're going to take a percentage off the top. There's got to be enough left for the business to run. And third, they need to be where cash is what's constraining them from growing. In other words, they've got a lot of things figured out. They have an opportunity to grow. But they need more cash to make that happen. That's where our capital is most appropriate, George.
It's a very unusual, very different kind of financing, Kevin.
It is.
Are other people doing this, or are you guys innovating, or where'd you steal this idea from?
Sure. We stole the idea from a company called Lighter Capital in Seattle. They've done about $100 million, private equity company. And coincidentally, their former chief investment officer, Molly Otter, moved to Boise from Seattle, and she's our investment officer now. So We know a lot about this. There are about 30 or 40 small companies around the country that are experimenting with this source of capital, and we're one of the leading ones in the nation now.
Wow. Is it taking off in Boise or in Idaho?
Yes, but I think like my associates on this call will say, we'd all like to invest money, but we got to make sure we get the money back. So not everybody qualifies for it, but we're looking carefully. But we will do anything in the United States and Canada. So we've done 2 deals in Boise. We have a term sheet for a company in New Hampshire, and we're in late stage discussions with a company in Manitoba.
Okay. So you're offering a different option that fits certain kinds of companies, and we'll come back to that.
Good.
Bruno, tell us about what you're doing with Zions Bank, SBA, and anything else you want to talk about.
Oh, George, thank you for having me today. Again, my name is Bruno, and I'm with Zions Bank. I'm in the commercial banking division of Zions Bank, and I normally work with small businesses with revenues between $1 million and $10 million. And today, I'll be talking about SBA loans and also conventional loans. A couple of things that come to mind when looking for SBA loans. I mean, a lot of people think that those are only for startup businesses, but SBA loans could also be used for established businesses. Now, what the bank considers, so what the bank considers candidates for SBA loans can be, again, companies that are just starting a business. And for SBA loans, there are 2 types of loans. We have what we call the 504 loan and also the 7A loan. Both of those loans could be used for anything that comes from real estate, equipment, machinery, working capital, and other fixed assets that the business will require. Now, the biggest difference between one loan and the other, when we look at 504, it's a type of loan that normally you will use for real estate, equipment, and machinery. And when we talk about 7(a) loans, that's more of a general purpose loan. And this type of loan normally you will use for business acquisitions, you're going to use for fixed asset purchases, for working capital, and also to acquire inventory. And it can also be used for real estate. So that's those are the 2 type of SBA loans. I mean, both have different requirements in the sense that for a 504 loan, we're looking at a 10% cash injection from the borrower. And with 7(a) loans, we're looking between a minimum of 10 to all the way up to 30% cash injection from the borrower. Another difference is the type of rate that you can get with this type of loans. 504, you're looking at an interest rate which could be fixed, or it is fixed in most cases. And with 7(a) loans, you're looking at a variable rate on that. And again, terms of these loans could be between 504 will give you a term between 10 to 25 years, depending on what you're purchasing. If it's real estate, we can go all the way up to 25 years. If it is equipment, it has a term of 10 years. Now, with regards to 7(a) loans, the terms are a bit different, but you can also go all the way up to 25 years with real estate. Anything that has to do with business acquisitions and equipment finance goes all the way up to 10 years.
So a couple of questions at the beginning, then we'll come back to you. But in terms of COVID, we've been through this. We are in the middle of this cycle. And I seem to recall SBA doing some special loans for that. Am I right?
Correct. When COVID first
Still
started,
going on?
no, those have stopped already. So that was called the Paycheck Protection Program. With
Right.
Now it stopped as of August 8th, I believe, is when the last time that any applicant had the opportunity to seek funding from SBA.
And possibly more program. We don't know what Congress is going to do and what will come, but possibility, I guess, of some additional programs if this continues.
There is a possibility that they will do a second round of PPP loans or Paycheck Protection Program loans. And as of now, we are waiting for SBA guidelines on what we need to do. So there is a possibility that we may see a second round.
Okay. Volume-wise in Idaho and in the region you're in, um, robust, slowed down? What do we, and I'll ask all of you this eventually, but what do you see happening right now?
As far as our economy, I think we are on track to continue to grow the Idaho economy. I mean, we're seeing a lot of home construction. So the economy is going to rebound. I guess when COVID first started, we were one of the few states who have a strong economy to start with. So therefore, I see that now that things are starting to open up again and businesses are starting to continue to operate, I think that our economy will continue to thrive.
Seems like we were late to the COVID party, which was good. Finally got caught up in it some, but maybe a little less impact. That's certainly up in the north. We've been, knock on wood, pretty cautious, pretty lucky to avoid some of the impacts of it. Most of our economy has, we've taken a hit, but it seems to continue. And I've seen a couple of growth opportunities happen this past week up in the Moscow area that are expansions, bigger expansions. So we feel pretty lucky to have had that too. Dave, tell us a little bit about what you're doing.
Thanks, George. MoFi is a non-bank lender. We're not a bank. We don't take deposits, and all of the loans we make to businesses in Idaho are to businesses that can't get their loans from a bank. They're what we call nearly bankable. So they have merits outside of what banks are looking at to make a loan. And loans from MoFi to a business in Idaho can be anywhere from, say, $5,000 up to $500,000. And they can be used for anything. They can be line of credit or term debt, working capital, equipment, real estate purchase, lots of different uses and sources. And we partner a lot with banks. Zions is one of our biggest partners in Idaho. We also partner with Sage Growth Capital. Businesses might come to us and it's just not the right fit. We might pass them along to Sage, or we might pass them along to Zions if we see that they are bankable. And, people talk about equity as being patient capital. I talk about our capital being impatient. It's impatient because we don't want you to stay with us. We want to help that business become bankable and move on, and not to be our long-term customer, but ultimately enter the financial mainstream and grow and succeed well beyond their time with us.
What would a typical client of yours look like? I mean, but tell us what that really means.
Yeah, pre-COVID, that would maybe mean it was a startup. Maybe the business didn't have enough collateral to borrow appropriately at the bank. Maybe there wasn't enough equity coming into the deal. COVID world, where we are today, fewer startups are coming to us than used to. About half of what we used to lend to were startups. There are fewer startups happening right now. We're starting to see that increase as opportunities keep popping up across the state of Idaho and elsewhere. What we're seeing right now, the largest numbers of requests are existing businesses that have survived the early days of COVID and now need working capital or new equipment or whatever it is for the coming 6 to 12 months. And those loans are by far what we're seeing the most of.
It's interesting. So fewer startups. Dave's seeing fewer startups, more money going to people that are surviving and need a hand with that. What about you, Bruno? Do you you mentioned you think our economy is stronger. What about the startup part of our economy?
And I will have to agree with Dave. We're not seeing very many startup companies at this time. We're seeing right now it's some existing businesses who are trying to take advantage of the low rate environment. That's what we're looking at. Other than that, existing established clients, and what we consider established client, anyone that has been in business for longer than 2 years, are seeking for working capital or seeking to actually inject more cash and start working on larger, more complex projects. So I guess there's a combination of businesses and of requests that we're seeing right now. Now, with that said, also because of the environment that we're in today, we are a bit more cautious when it comes to lending, and we are now requiring a bit more paperwork as well. And so one of the things that we have implemented is tell us about how COVID has affected your business. And so there's a questionnaire with 5 questions that we ask, and to have a better understanding of where they are today, how management has, been through this today, like what they've done to make their business better or to at least stay open.
We're talking about the growth track, and what you say fits right into growth. A lot of companies are looking to survive and then find new opportunities and grow, and maybe startups a little suppressed. We'll ask Kevin that in a moment. But also our theme really is being resilient and to survive. I'm sure all 3 of you see that companies have to be resilient, innovate, find new ways to do things, or survive for a while until opportunities present themselves. Kevin, what are your thoughts on where we're at economically, startup-wise, growth-wise, the kinds of deals maybe you see, or just you understand the entrepreneurial environment in Idaho?
Well,
so
I'm a board member of the Angel Capital Association and very involved nationally in angel investing, and there is a slowdown clearly. Valuations have dropped. It's harder to raise early stage capital. And that is a cycle that we go through every time there's something going on in the economy. So that's a reality that we have to face. I think in the growth track, the next reality is, but my business is doing okay, but I need more money to make it go. Yeah. I'll give you for instance, we invested in Louis Armstrong's company, which produces the Killer Creamery ice cream, and it's a keto-friendly ice cream. It's selling like hotcakes. It turns out that pandemics are really good for ice cream sales. Yeah. People need entertainment. They go to the store, they buy ice cream, and then it turns out that ice cream is a recurring purchase. Once they buy it, they go buy some more. But when that happens, the business needs capital. It's got to finance the inventory and the receivables. And so we made an investment in that company. And I would sort of, structure the 3 companies that are here. If you have the balance sheet, the collateral, the credit capability to borrow money from Zions Bank with or without an SBA loan, I think we'd all say you should do that. That is really good.
That'd be number 1.
That'd be number 1. Now, that's where Dave's business comes in, because people are almost there but don't quite have the strength. That's what MoFi does, and you should go there if you can.
And if someone doesn't qualify for Zions, MoFi is an option, and Dave wants to talk to them. And you're probably not at that point, Kevin, I assume.
Our businesses typically would not yet be financeable by Bruno's Zions Bank. Might be by Dave if we found the right situation, because since we don't take collateral, we might be able to put money in that would then enable Dave to put money in on top of that.
I see.
What we are financing are early stage, high growth companies where that growth is starting to accelerate. Typically, they will have raised some equity capital to support them. And their decision now is, do they go sell more stock, which of course dilutes all the current owners, or could they take on debt from someone like Sage and make those sales go up, which will make their company more valuable, and then they can return to the market, perhaps for equity on down the line. But so we're going to finance growing companies that are not yet strong enough to get capital from Dave or Bruno's businesses.
And maybe not quite ready to, or maybe don't want to go out into the a stock option or venture capital or something else.
And it's really hard to sell stock right now.
Yeah.
So that's part of, that equity market may not be available to them, at least at a price that they're willing to pay for it. And the price in equity is what percentage of your company you're going to sell off. in order to raise that capital.
And anytime you can find non-dilutive money, you can get funding that doesn't take away your ownership. I'm sure that's got to be attractive to an entrepreneur. Okay. All right. Maybe a question for each of you, and you've answered it in some ways, but when's a business or an entrepreneur ready for your type of funding? Is it startup stage, growth stage, revenue size? You've talked about different things, so kind of reiterate that a little bit for me.
Maybe I'll jump in.
Okay.
Go ahead. By all means.
For us, any business can be nearly bankable at any time, whether it be a startup or an established business for 30 years. We've seen it happen to businesses that have been around a very long time where they just don't have the asset base to borrow against for their growth, or it's a brand new startup. And so any and all businesses can be nearly bankable at some time. In fact, I have run businesses in the past that were nearly bankable, and I have been in that position. And it's one of the reasons I do what I do now, because I understand the plight of the entrepreneur when you can't quite get all the money you need from a bank.
So you take a little more risk. I assume you're taking a little more risk because you're not quite bankable or don't have as much collateral or some of the things we might traditionally that Bruno would look for. When they come to you for funding, Dave, what do they need to show you? What is it you're looking for in terms of, I don't know, I guess you want to see the revenues and some financials, but what do they have to bring you to? A new client, let's say a new client, do they show you their pitch deck? Do they bring you a business plan? Do you ask a lot of questions? What do they need to bring to sit down with you?
That's a good question, and it's very different from startup versus established business.
Mm-hmm.
With an established business, we'd want to see historic performance. And if it's a turnaround situation, we'd want to see historic performance. And then we'd also want to hear what their plan is for their turnaround, how they're going to get it right. With a startup, there's a perception in the world that you need a full-blown business plan and some massively complex projections for 3 years. And for us, we need a description of the business, 1 page. Tell us what you're doing, where you're going, and how you're going to do it. And we need 12 months of projections.
Real good executive summary and
exactly.
Here's how I think we'll get there.
Yep. Yeah. No pitch decks, no full-blown business plan.
Feel better, hearing that they don't have to. I mean, we all believe those projections, those 5 years of
right.
growth, but you don't have to go through that pain or that process. Always a good process to go through. I teach, so I tell my students, that exercise is really important. It may just not be what MoFi is looking for or some others. It's shifted a lot. And Kevin, I know you can speak to that. The industry, the startup world, the angel investors, the venture capitalists, and the banks, they look for different things than maybe they did 5 or 10 years ago, and certainly longer than that. The days of a 40-page business plan with, as Dave said, years of financial projections month by month, you just don't see that quite as much anymore.
We used to always teach that, and then one day I heard Steve Blanks say, they need to teach that in the creative writing department over in the English school.
Yeah.
Just a guess, right? But I can be quite specific in terms of what we look for, because we're financing companies that are growing. So they got to have revenue. So in our case, they have to have $300,000 worth of trailing 12 months revenue. Okay, that's our first cut. At least that. We prefer they have more. We can loan up to 1/3 of trailing 12 months revenue. So if they had $300,000 worth of trailing revenue, and that revenue is growing, then we could loan up to $100,000. Right? So we're looking for companies. We don't do startups because we can't figure out how to underwrite when they have no revenue, because we're taking a percentage of that revenue. So we're going to look at that. They're going to give us some projections. and they're going to give us a set of financials. And that's what, because we're a cash flow investor, we're going to look at that very carefully, and we're going to understand where we think the sales are going. That's the risk we're taking, because there's no fixed payment with us. Our payment is dependent upon the sales of the company. We're making a bet that if we put that capital in, those sales are going to do that. And if they do, we're going to get paid off faster, which makes both the business and the investor happy. So that's, we're trying to understand, and we will create our own projections of where do we think the revenue is going to go if we put this injection of capital into the business.
Okay, good. Bruno, same question, I guess. What do they need to bring you to get into the bankable situation or SBA situation?
Well, unlike Dave here, one page will not cut it for us. We would like to know everything and anything about the business, about the guarantors, owners of the business. For example, I just finished up working with a client who provided us with a 15-page business plan. And then on top of that, we do require 2 years of month-to-month projections to be able to do a deal for SBA. Now, projections, before we didn't really need them except for startup businesses that were looking for SBA financing. Now, for any type of conventional lending, we normally don't require projections. Now, nowadays, because of the environment that we're in, everyone who is seeking financing, whether it is a startup business, established business, we need to see projections. At a minimum, we're looking for 2 years of month-to-month projections. Business plans are required only for startup businesses. Now, in this case, we definitely want to know who you are, what you're planning on doing, what type of investment are you requiring from the bank? Although we're lending you the money, so we need to know exactly how you're going to spend that money. So the more detail you add to the business plan, the better chances that you have for us to actually provide you with some sort of capital financing that you will need for your business. Now, startup businesses, again, we will base the loan amount is going to be based on what their projections can bear. Now, for businesses that have been established or have been in business for 1 year or longer, and then we'll need 1 year of tax returns plus year-end financial statements. Normally, for any business that has been established longer than 2 years, we like to go deeper as of 3 years of tax returns, 3 years of year-end financial statements, year-to-date financial statements, and then we look at everything. So again, I can go on as much paperwork as we need, but again, it depends on the type of business. It depends on what we're trying to finance. So for example, if you're looking to finance just a piece of equipment, all I give you is one piece of paper and say, fill this out and tell me what your cash flows look like, and sure, I'm done with it. So it's a simple process. If we're looking for real estate, well, that's a more involved process. So therefore, I may need more things from you. So again, each business is different. And as many of you probably have heard this, when it comes to commercial lending, it's always the answer that you normally get for any question that you have is always, it depends.
It depends.
Yeah, every business is different.
Hard assets, easier to less things that you need. If you've already got a year or two's returns, you can see that in a startup. You can't always see that, so you have to dig deeper. Maybe for all three of you too. I think about any situation in funding, raising funds. I always say how important the founder or the founding team are. And we're talking about documents and projections and cash flows and all that. But how important is it that you understand the person you're talking to? And I assume you have to talk to them, or in one way or another, in Zoom or otherwise. How important is the leadership group or the founder, and no matter what the numbers say, I guess?
let me take that and see, and then I'll throw it to my colleagues, because the people listening to this, there are very different requirements for each of these sets of capital, and it deals with risk, right? When I write a check on my account at Zions Bank, I don't want Zions Bank to say to me, "Gosh, we don't have the money because we loaned it to somebody and we lost it," right?
Yeah.
They're not in the risk-taking business. They're in the risk management business. Dave is kind of in the middle of this. He's taking risk that the bank won't take, but he's got to get paid back. We're at a much riskier stage. But I would say this, that is it the 4 C's of capital, or 5, whatever it is, Bruno, but one of them is character, right? And I'm sure that every investor is interested in the character of the people that they might invest in, whether it's a loan, whether it's stock, whatever it is. So we have to have confidence that if we make an investment in this business, that the people are going to do their darndest to carry out what they said they were going to do. Sometimes things happen. That's understandable. But we want to know that the people are going to carry out and be people of integrity, honesty. All those things are kind of like, if you don't pass that hurdle, you don't get to the next stage for any investor.
Okay. Anyone else want to weigh in on that?
I'll jump in. Very well said, Kevin. That was great. Absolutely, we lend to people. People run businesses. And for MoFi, one of the things we look at really carefully is how much grit they have, because it never, ever turns out the way the projections say they're gonna. And if you have grit and you know how to roll up your sleeves and pivot and make it happen for the business, sometimes way off plan, that is what we're looking for. And absolutely, people who pay back loans. If you borrow money, you have a responsibility to the lender to pay it back. And sometimes that is from means other than the business that was financed, whether, you go get a job and pay back the loan. Those are the things we're looking to find in the world, people who can get it done.
Dave, if you have someone that does business with you, gets a small loan, that $5,000-$10,000 shot in the arm, and pays that back, comes back again and needs money for expansion, easier to make that second deal, I guess?
Yeah, in fact, we had loan committee today for a business that paid off a loan to us about 2 years ago, and they were expanding their current business, the second facility, and loan committee was real quick because we know those people and we know they can get it done. Yeah. Great question.
Okay. All right.
George, I'll make one comment. I mean, we do background checks on our entrepreneurs, okay, and several times we say, okay, well, we need you to send these paper to do a background check, and you get pushback.
Yeah,
it's a sign to run the other way.
Yeah,
right. And I'm sure that my colleagues have that same experience. It isn't a guarantee or anything. You're just going to do it. We want to know what's going on back there in the history of these people, and have they paid their bills in the past.
And this is one thing that is true about dealing with people. When it comes to SBA lending, if you have any felonies, you are automatically disqualified from it. So again, we do run a background check on deals that are over $1 million, but SBA will automatically stop doing business with you if you have a felony. Any other conventional type of lending, we'll do a background check, which is loans over $1 million. But again, we are doing business with people. I mean, from the moment that borrower approaches me requesting financing, I need to understand who he is, where he comes from, and is he willing to invest in his own business? I mean, because a lot of times if they don't want to invest on it, or they just don't want to give you what you need, you may just want to walk away, really, because again, we're doing business with people, and we need to get paid. I mean, just like anyone else.
And last question, we're almost out of time. After you've decided someone has character and isn't just a character, someone, the idea, the revenue stream, whatever it is, you say, okay, this is a go. you give them the cash, you give them the money, give them that help, but do you stay with them? What do you do after you establish the initial financial relationship?
Well, in our case, we get access to their bank account. Not write checks, but we're going to look at that bank account every month. We have a standard report. The company files a report with us. It's due on the 5th business day of the month, which is coming up. And they have to tell us what are the total deposits to their bank account and what deposits were not from sales. That's how we're going to figure out how much we get paid. We're going to agree upon that amount. The companies have to file with us their financial statements every month. We want to see their tax returns. We want to see their employee tax returns. Standard information, that all goes into a repository. And much of that is so that we can stay up with the business. We want to know they're paying their employment taxes, for instance. We want to know they're paying their taxes if they're due. We, unlike angel investors or traditional venture capitalists, however, we don't get involved in the management of the business. If somebody wants to ask us a question, we're happy to respond. But once we've made that loan, we're going to watch the sales and we're going to take our piece of that. We're going to report back to the company where they are in terms of the total amount of money they owe us.
Okay, a little different than the angel investing you do.
Very different.
Yeah,
And
Dave,
because our job in the world is to make nearly bankable businesses bankable, our loans come with love and lots of it. And that love comes in the form of bookkeeping, assistance with marketing, operational support, HR support. We're trying to help that business in those first couple of years with us not step in the mud so that they become bankable faster. We can send them along and move on to the next business.
Okay, Bruno, we're talking about alternative financing. I'm not sure banks and SBA loans are so alternative, but we don't always think about that sometimes in the startup world. What kind of relationship are you trying to build with your clients?
Normally, again, we are not a transactional type of business. I mean, in banking, we are more of a relationship base. So if you're a new client to the bank and we lend you money, we definitely are going to set up the loan depending on the loan amount. We may put some loan covenants, which require you to provide either year-end financial statements, tax returns, or any of those. But in that regard as well, what we do is we want to see that you continue to be profitable. And if there are any issues with that, then we will try to help you to get to the next stage, or at least advise you on things that we're seeing. In most cases, we see clients who are so new that they don't know how to price certain things, or they just don't understand our ratios. And so, part of our job is to make sure that we spread their financials and tell them, hey, this is where you are today. Based on these numbers, I recommend that you do this. So we always recommend different options to clients on how to increase their profits. But again, ultimately, our goal is to grow that relationship, is to grow with that client. I mean, there's some clients that just started today. 3 years from now, they are running a large enterprise, and that's what we would like to see.
So in wrapping up, Idaho's a small state, but a vibrant state, vibrant entrepreneurial community. The Northwest is that way. You guys are all working to help us build something or to keep the growth going. I like that you work together, partner together, recommend to one another that we're all in this thing together from our perspective in higher ed, but you're certainly in the finance world. I appreciate all of you coming to talk to us today in the Grow Track, and you've provided insight to the entrepreneurs, the small businesses looking to grow out there. Here are some options that maybe they didn't know that they have. So your contact information is all posted, and they'll be able to see that. Hopefully you get some calls out of it. I really appreciate all three of you talking with me today. Thank you.
Thanks, George.
Thanks, George.
Thank you.
All right. Talk to you soon.